Hello guys, today's video is about a stock that recently came back to my radar again. It's a company that I've been following in the last 2 years. In my opinion, it's a really good company. Let's talk about Restoration Hardware. What is Restoration Hardware? Restoration Hardware is a retail who sells furniture, textile for the house. It's a high-end furniture company. Um, this company recently come to my radar because the stock just crashed last year. They they were trading around 700 bucks, and now they are trading around $236. It's a really good company, and I will tell you why. It's a company Berkshire Hathaway owns. They, I think they bought recently more stock of it. I don't know, maybe in the last quarter. I'm not sure, but you can check it. So, what is Restoration Hardware? It's a retail company. They are in the consumer cyclical sector. They sell high-end furniture, so it's a small cap stock. It's their market cap is around 5 billion. Um, they have been growing a lot. They are trading at a PE of around 12. Um, they have been growing in the last years. You can see their revenue grow. Their revenue in 2017 was around 2.5 billion. They made a record on 2021 at 3,800 billion dollars of revenue. Um, this last year, their revenue came down around 4.5%, and this analysts are expecting their revenue to be down this year to the 3,100 million dollars, almost 3 billion. They should be down around 13%, but for the next year they are expecting they continue to grow. So things we like of this company, they have been having a good return on invested capital, an awesome return on equity, which is really good for a retail company. Uh, they have really good margins for a retail company. They have gross margin around 50%, and their net margin have been around 15%, which is really good. They have been growing good growth around 8%. So this year, their performance year to date is they are losing. The stock is losing 11%. In the last month, they are down 15%. So that can be an opportunity. So let's check our money on the checklist. The revenue growth, it's a check. They are growing 8%. They have good margins. That's a good indicator for the stock, and we are always looking for stocks with a good moat, a good competitive advantage and margins, and a good business with a good moat and a good competitive advantage. They usually have a good margin, so they are selling high-end furniture. Of course, their margins will be higher, and that can be a kind of moat. Debt. They have a lot of debt. Their market cap is around 5 billion, and they have almost 2.5 billion on long-term debt. Long-term debt, but they have a lot of cash in hand as well. They can pay almost more than half of their debt. So they have a lot of debt, but they have a lot of cash as well. So that's a cross on the low debt, but I believe that can be manageable. And since they are growing, they have a good management team. So I think it's not across entirely, but it's not good. But I believe it's not a problem. Return on invested capital. That's a check. They have a high return on invested capital. They have high returns on their equity investment, which is something we really like for the long term, and for a company we really want to own. Moat and competitive advantages. I have it here. I don't know. I don't have the knowledge to talk about their moat. I believe they have some competitive advantage. They are one of the best companies selling furniture. I believe everyone on the United States loves restoration hardware, even though they are selling a high-end furniture, which is really, they have a really high price for the furniture, but they are growing, so people like it, and I believe they have some kind of moat. I'm putting a cross here, but it can be a check as well as as the debt. So they have been free cash flow positive for the last years. They have been a lucrative business, which is really good. They have been returning capital, not by dividend, but they are buying back their shares. That I believe that's why Berkshire Hathaway loves the company. They are one of the owners. They have a lot of shares on this company. I believe they really like their return on invested capital and their buybacks. So fair valuations. I already have it here, but let's check our discounted cash flow. I'm expecting the revenue to go down this year around 13%. It's just the analyst estimates, and I believe they can resume their growth in the next year. So for my base case, I will expect 8% in the next 5 years and 5% for the next 5. I believe it's a conservative expectation. I think I'm being conservative. For my net income margin or free cash flow margin, I'm putting around the 15%. Last year's their margin was around that, and it was a rough year, so I believe it's possible. Even though they had 18% margins in the 2021 year, I believe that can be a flux since they growed a lot in that year. So for a P, I will expect a 16. I'm doing the median P for the S&P 500 should be around 50%. 50, not 50, 15. So I'm doing a little premium here, just putting a 16. I could put a P higher since they have a really high return on invested capital, but should be conservative. So my discount rate for my base case is around 12.5%. So for my bull case, if they really kill the business, if the revenue come in, if they grow even more around, I'm expecting in a good year around 10% for the next 5 years and the 7% for the 5th to the 10th year. 17% margin if they can optimize their margins, and 18 PE. For my bear case, around 6% and 3% for the last 5 years. 14 PE and 30% margins. I believe this is really conservative, so 10% discount rate for this case, and we come in with our intrinsic value would be around $200, around 198. So what we think about this business? They are trading around 236. It's around their high price for the 2020 year. Before COVID, they were trading around this value. So they are now here. In the last year, the stock really crashed, and I believe the bottom. I don't know if it is the bottom but they're low in their 52-week low. It was around 210, I believe, but the stock really just skyrocketed in the last year, and they recovered to 350, almost 400, and I didn't follow the stocks. So now that they are trading around 236, I might get interest. For me, it's a good company. I really love to own it. I don't own it, but it's a retail company, and without this happening, maybe we can get a recession this year. And if we get a recession, maybe a earnings recession, retail stocks will suffer. Maybe we can get an opportunity to get this company at a cheaper price. That is what I'm expecting. Not expecting, but hoping. I really like this company, but I believe we have a better opportunity right there in the retail. One company I really like is it's like a similar company to Restoration Hardware. I really like Williams Sonoma. It's a retail company, but they sell other things. It's almost all check marks. It's trading below our intrinsic value. But this video is about Restoration Hardware. I might do another video on Williams Sonoma. If you want. If you want a video on Williams Sonoma, please write in the comments. So, what I think about Restoration Hardware, a really good company, and I'm hoping that the stocks go down even more. I might get interested around to $200. I might start a position there if we had that opportunity. I believe it's a good company, almost all check marks. That is not low, but it's manageable. I believe they have some kind of competitive advantage, and they are a small cap. They have a lot to grow if they continue to do a good job like they are doing. So I'm a little afraid to invest in retail stocks because of maybe we have a recession. But if the recession happens, you might get a better entry point in the future. So that's what I'm hoping. I might start a position around 200. I don't know, don't take my word for it. Just do your due diligence as always. And that's my opinion on the Restoration Hardware. So if you like it, please subscribe and write in the comments. Bye guys.